On today's Hot Sheet, I'm discussing the state of the American dream, the ICE Mortgage Monitor report for November, and mortgage applications for the past week. Today is Wednesday, November 12th, 2025. I am Byron Lazine, and the Hot Sheet starts now. Live from Connecticut. Pleasure to be with you wherever you may be here today. We've got some interesting news on mortgage applications. We'll get to that. First, let's start with the Coldwell Banker State of the American Dream. Yeah, I think they come out with this annually, this report. I don't know if next year it'll be called the Coldwell Banker State of the American Dream Report, or it'll be called the Compass State of the American Dream Report. That remains to be seen. I chatted with a whole bunch of Coldwell Banker friends in Vegas last week, and nobody really knows. So there you go. Here's the deal. According to Coldwell Banker's 2025 American Dream Report, 71% of aspiring homeowners, would-be homeowners, hey, I want to buy a home in the future. The dream is still real for these 71% of would-be homeowners. They're delaying major life decisions until they can afford to buy a home. Okay, so Coldwell Banker's making the claim that the ripple effects of that, of pushing out major life decisions, have yet to play out. So it's a story about how home ownership is a new starting line for adulthood. Like, hey, I don't want to, do some of these other, adult-like things until I'm able to own a home. Okay, so kind of picture this: a couple postponing expanding a family because they want to have the backyard first. They want to have the backyard ready to go for the family. The professional who's turning down a career opportunity in another city because they're saving for a down payment right now. Personal goals and even adopting a pet are put on hold, waiting for the first home. Now, I don't see anybody waiting, like putting the pet on hold. People are obsessed with their pets. That's how they're coping with life. So I don't really see that. Okay. But CB says that that's what they're seeing. I completely disagree with this analysis from CB that people are putting off having a pet. I mean, I don't see it. Everybody who longs for a little doggy in their life seems to get one. Nearly 1 in 5 aspiring homeowners, 18%, are putting off marriage. I see that for sure. Putting off marriage or having children for sure until they're able to feel like they're financially stable or in a position to own a home. 17% are delaying career changes or even getting a pet. No. Coldwell Banker, I just think you're dead wrong. I don't know where. Let's see where the data came from on this real quick. Athena Snow, senior manager, public occasion, put this together. I'm not seeing how many people were actually. Oh, so this includes data surveyed, commissioned by CB and by the Harris poll among 3,068 adults ages 18 plus, among whom 885 are aspiring homeowners, currently don't own a home but would like to someday. So again, a lot of these surveys that are done, this particular American Dream survey that CB puts out annually, you get a small sample size, and I don't know. I just, quite frankly, don't believe the pet thing at all. For younger generations, the impact is even more pronounced. 84% of Gen Z, they found, ages 18 to 28, are aspiring or postponing. They're aspiring homeowners, and they're postponing one major life decision until they can afford to buy a home. So here you go. Here's the annual report from CB. 71% overall delaying kids. 85% of Americans believe homeownership is still part of the American dream for most. I do agree with this. I was I was in my local cigar club here in Connecticut last night, talking to an old school sales guy. He's an IBM sales guy, still does consulting to this day, just loves sales, loves talking business, economy. I walk in last night. He's got CNBC on the screen, kind of following up with the after hours market. And he's of the belief, because his kids are in that mentality right now, live in the big city, rent, kind of grow the career, continue on with never ending education. He's of the belief that young people want to be mobile and free and don't really want the American dream. He's like, yeah, kids, they just want to rent. They want to live in big cities. They want to be able to get up and move whenever they want. And I just don't find that to be true. I find the younger generation, Gen Z, really aspires to home ownership. And so this is part of that. This is part of the CB report that I definitely buy into. That 85% of Americans believe home ownership is still part of the American dream for most. I buy into that. I definitely see that with young people that I engage with. 83% of those Americans who don't currently want to buy someday. And so 56% say owning a home represents the American dream more than marriage or children or retiring by 67 or earning a college degree. Okay, there's some of the highlights from the maybe the last year of the Coldwell Banker American Dream report. We'll see what they do with it next year if the Compass deal closes. Okay, moving on to ICE, not Chicago, not the ICE you're thinking of. Okay, the Mortgage Monitor report from ICE Technology for November 2025. Okay, so put this out every single month. Each month, the ICE Mortgage Monitor examines key trends and developments in the mortgage and housing industries. And they're taking a deeper look at mortgage performance data from their most recent First Look report, which tracks delinquency and foreclosure trends through the end of September, with a focus on FHA lending. Okay, so here's the overview right now of mortgage performance according to ICE Technology. Delinquency rate is down 2 basis points. So foreclosure activity trending higher off of a recent record low, largely driven by a resumption of FHA foreclosures. When you can't foreclose, you're going to be at record lows. We've been at record lows, and we get a little bump off of record lows from the resumption of FHA foreclosures following last year's moratoriums. Okay, but this ultimately remains low from historical perspective. Okay, really important. The 23% off of foreclosure starts, the 23% bump up here is coming off of basically nothing. Okay, that the headline number is still a historical low. Foreclosure starts surge year over year in Q3, but they're 18% below pre-pandemic levels. Okay, foreclosures are much healthier than we had in 2019. And 2019 was just a very normal year. There wasn't high foreclosures there either. Loans in active foreclosure increased 18% year over year, but remained 22% below 2019 levels. Okay, and you see delinquency rates actually going down month over month, not up. Okay, prepayment activity, single month prepayment activity up 12%. Prepayments were up almost 15% year over year on prepayments, according to ICE Mortgage Technology. Okay, that national delinquency rate fallen 2 basis points in September to 3.42%, down 6 basis points from the same time last year, and 58 basis point below its September 2019 pre-pandemic level. So national delinquency rate of first lien mortgages. This is obviously different than that foreclosure stat. Okay, this is a future indicator of what could be coming for potential foreclosures. This is doing historically well. 3.42% delinquency rate is historically low. The average from 2025 to rather to 2005 is 4.55. We're a full point below the 2000 to 2005 average. We're near the absolute record low of 3%. These are historically low numbers for the delinquency rate. This chart here is the one. It's inside of school for BAMX members. You can pull it. This is the one to send to your, customer's dad who's like, I think there's going to be a wave of foreclosures coming. Still has GFC PTSD. Non-current rate of first lien mortgages by product. So FHA is the one to keep an eye on here, ticking up slightly above pre-pandemic levels. FHA loans for an increase in borrowers who are not current with their debt. VA's in line with where we were pre-pandemic, and GSE and portfolio loans are both below where we were. So FHA is the one to look out for. There were 103 foreclosure starts in quarter three, which is that 23% from the same period last year, but 18% below 2019's levels. Just kind of looking at foreclosure starts and active foreclosures on a bar graph going back to 2015. Again, this is another one that paints the picture that we are not getting into some type of mortgage crisis here in this country, and certainly not as it relates to foreclosures. Here's where you are seeing foreclosure rates tick up. Okay, you've got the lowest foreclosure rates on the some of the areas on the West Coast, San Jose, Oxnard, California, San Francisco, San Diego. Those are the top 4 lowest foreclosure rates in the country. Grand Rapids, Michigan is on the list. Boise, and Boise's got some inventory, and they've got low foreclosures. LA, Nashville, Raleigh, North Carolina is on the list. Denver, Boston, Austin, Chattanooga, Seattle, Phoenix. Okay, so those are the lowest foreclosure rates in the country. The highest foreclosure rates would include Baton Rouge and New Orleans. So you've got Louisiana at the top of the list. Syracuse is on the list. Lakeland, Florida, Albany, Youngstown, Columbia, South Carolina, Deltona, Florida, Jacksonville, Florida, Scranton, Pennsylvania, New York is on the list. Rochester, Cleveland, Honolulu, and Tampa. So I would have actually thought a little bit more Florida on the list. Lowest year-over-year change, New York, Albany, Boston, Bridgeport. And the highest year-over-year change, Houston, Colorado Springs, Denver, Provo, Utah, Detroit are the tops of the list. Cape Coral, plus 57% highest year-over-year change. Tons of inventory. Wall Street Journal says Cape Coral is the worst housing market in the country. All right, there you go on just the ammunition you might need to be able to help people understand where we're at on stability in the housing market and foreclosures. I'll add a couple more here. In the money mortgages under the various 30-year scenarios. Okay, so 30-year fixed rate scenarios. Who's in the money? You've got a lot less in the money mortgages when you get up over 6%. You get down to 5%, and you got 13 million homes, 12 million at 5.13%, 5.25%, 11 million homes that are all in the money. And we're starting to, now 3 years high rates, you're starting to see some pressure alleviate with some of these mortgage holders in terms of getting the gap closed. We're going to see that here in a minute with some of the mortgage application and refinance application numbers. Okay. All right, there you go. Let's move to mortgage applications. Headline number, very interesting for this time of year. Mortgage applications increased 0.6% from a week earlier, according to Mortgage Banker Association. And That's the headline number. So that includes refinance. We know refinance has been driving huge gains in comparison to last year. Year-over-year gains on refinance has been large all year. Okay, the refinance actually though decreased as rates went up in the past week, 3% from the previous week. Now it was 147% higher than the same week a year ago. But it's down 3% from the previous week. I expect that rates go up. I expect a week over week decline in refinances. But what I also expect this time of year is that the purchase index, what we really care about, to decrease week over week this time of year throughout the end of the year, especially without some big downward move on the 30-year fixed rate, which we didn't get. We got a slight increase. Yet the purchase index went up 6% from a week earlier, 31% higher than the same week a year ago. Purchase applications picked up almost 6% over the week due to the strongest pace since September, Joel Kahn, Mortgage Banker Association Vice President and Deputy Chief Economist said. This is despite mortgage rates increasing slightly, with the 30-year fix going up to 6.34. Purchase applications for conventional FHA and VA loans all increased. So potential buyers continue to shop around, he goes on to say, particularly, this is what's interesting, particularly in markets where inventory has increased and sales price growth has slowed. So I'm like, okay, what markets could those be? You know, you could be thinking Southwest Florida, South Florida, inventory's increased. Well, we just had a bunch of New York Post articles suggesting that the phone is ringing off the hook. And so maybe there's home shoppers down there right now, obviously with the New York City election. I don't think it's going to drive numbers that are going to move the market, but it's been good for a lot of headlines. You can check out my full thoughts on that on Knowledge Brokers podcast from Friday. We also had Josh Rubin, New York City, one of New York City's top brokers, on to discuss that. But I really don't know unless we're just seeing smart, savvy investors saying, hey, I'm going to go invest in the Sunbelt states now if I think that the rates are going to move down in 2026. Obviously, there's, talks about, this 50-year mortgage. Maybe, investors believe that, hey, there's going to be momentum in the 2026 market. There's going to be an administration trying to throw everything, the kitchen sink against the wall to try to get transactions moving. If rates do come down, transactions should naturally move up. And there's a glut of inventory and sellers who are willing to negotiate. Maybe we'll go and, negotiate on some of these homes, or just savvy buyers are saying, hey, now's the time. Winter's the time to go and negotiate. It's just interesting where there's been the most inventory and seemingly downward pressure on prices and the slowest markets is where Mortgage Banker Association is seeing this uptick in mortgage application at a time of year when you typically see a decline, and at a time of year when you also see, these numbers just moving down. So, all right, this demand on mortgage, by the way, is the highest level since September, despite these high or these rising interest rates off of where we've been. Market liked the momentum here on the shutdown yesterday. Stock markets went up. Nearing again record numbers again yesterday, and we're seeing the 10-year get a little bit of a move down here today. This is one of the lowest levels we've seen over the past year. It's back trending towards some of the low levels we've seen over the last 3 months. 4.069. To start the day on the 10-year. So maybe we get a little bit of help on the 30-year today when we get that read. Yesterday we came in at 6.34. No, that's not yesterday's read. Why am I not getting?
Was it because of Veterans Day?
Oh, yes. Thank you, Haley. Thank you to our veterans too, by the way. Yeah, so we had no read yesterday with Veterans Day. Absolutely correct. Haley's on the ball. 6.34 was the final read we had on Monday. We'll get a new, fresh 30-year fixed mortgage read today. Was the stock market was open though yesterday, right? on Veterans Day? Yeah. Of course it was, because I just mentioned those big numbers. All right. Poly Market says Fed will cut in December, 72% chance there. I'll keep our eye on that. Try BAMX for free for the next 7 days. Use the link down below, school.com/BAMX. Love to see you in the school community each and every single day. All the slides that I use on the hot sheet are available for you inside of school, each and every single one of them, as well as all of our hot sheet show notes for you down at the bottom of that. You get access to our Tuesday role play masterminds with myself, Tom Tooley, Lisa Chinati, every single Tuesday right before the hot sheet. The conversations that help you convert more deals and close more sales happens every single Tuesday for members only. And today, Chris Benjamin is going to be going live in the community at 4:30 Eastern with Dave Childers of KCM, deep dive on what's ahead for real estate in 26. So get some insights, early insights on Dave Childers' projections and forecasts for 2026 that's happening today. Members only in school. You can try it out for free for the next 7 days if you go to school.com/BAMX. All right. There's your hot sheet here for the day. Be looking forward to being back with you here tomorrow morning. Until then, toodaloo.